Welcome to Gold Silver Pros.
Hey everybody, this is Rob Kientz with �GoldSilverPros.com. It is Thursday, January 25th, 2024. And I wanted to do a video today on the potential for gold prices in 2024, but I wanted to look at it from a different angle. We're going to look at it from one angle about what the Fed is doing both with interest rates and the Bank Term Funding Program, which we've talked about, and why their recent stance and recent announcement on limiting the Bank Term Funding Program is likely to lead to a bigger economic issue, and why gold is more likely to spike because they're limiting that program. And I'll get into that. And it has to do with the banks and risk of the banks in the system, because the banks are the biggest risk to the economy. If they go boom like they did last March, you're going to see a spike in gold price like we did last March, April, May timeframe, leading up to the summer where gold started to come back down. The second thing I want to talk about is the ability of oil, or another commodity, the leading energy commodity in the world, to control the price of gold, because that issue and that topic has surfaced recently on the internet, and I want to address that. So we're going to address a couple of big things that are going to affect gold price in 2024. One, the banking system and interest rates and what the Fed's going to do. And two, the largest commodity used to trade for gold, which is oil, and how oil affects the gold price. So let's first, and both of those things are going to help determine where gold goes. And I think you're going to see both of these are actually going to be bullish for gold. Of course, I'm a gold channel. People expect that, but we're going to go over the data why I think that's going to be bullish for gold in 2024, and how I don't think whatever oil does is going to stop gold when it's time to run. So let's talk about that. But first, we're going to start off with the Bank Term Funding Program. So here's the announcement from the Fed, press release yesterday. The Federal Reserve Board announces the Bank Term Funding Program will cease making new loans as scheduled on March 11th. This is not new news, although it has caused quite the Twitter storm, thinking that the banking system is about to melt down. Well, originally they said we're not going to make any more loans after March 11th, but you still have until the next year to pay it all back. And so the Fed is basically standing their ground saying we're not going to bail the banks out again. That was a one-time deal. I think they think that they've got control of the economy and they're not going to need to do more bank term funding to bail out the banks like they did last spring. I think they're wrong. But I think that's where the Fed is. And this is giving you a clue as to where the Fed sees things heading. The Fed sees a soft year in 2024. They've already announced the intent, more than likely, although not specifics, on cutting rates. I did a poll on Twitter and I asked how many rate cuts do you expect to see? And people were saying between 3 and 4, I think, was the winner. I'm not convinced. But I do think that the Fed sees a soft economy. And I do think that they're not going to bail out directly through bank term funding and other programs. But I do think that they're ready with the interest rate cutting, so that as things get a little choppy, they're going to cut interest rates, and they think that they can manage it. They think that 2024 is manageable. I think that they're nuts because of the risk in the system, but I think that's what they believe. And so they didn't change anything with bank term funding, but I think they put out this press release to let people know we're not extending it, because there's been a lot of conjecture around whether they're going to have to keep this up. And they're saying, no, we're not going to keep it up. And they're announcing this on January 24th to let the banks know, come to the trough while you can, because after March 11th, you can't. So on one hand, the Fed is basically encouraging banks to come to the window, the Bank Term Funding Program window, and get their loans now. And then you have that year to pay it off until 2025. So they want as many to come in right now so that they know for the rest of the year what risk they got to manage. And so that helps them determine where they're going to cut interest rates, because they're going to know how much is in that BTFP. Because think about it. It came out, there was about 40 billion allocated. It went up to like 134 billion, I think. So I think they want to know by March 11th how much that fund is going to be. And then they're going to use interest rates to manage what they think is going to be a manageable economy. And obviously, they don't think the risk of the banks is persistent. They think it's quote unquote transitory, that famous word that we've had with the Fed. I think they're wrong based on debt levels and based upon defaults coming up on student loans, real estate debt, and all those things I've been talking about over and over and over again on my channel. The fundamentals haven't changed, but the Fed is going to apply a policy tool that they think is going to address the fundamentals. The problem is, by making some rate cuts, you're not going to change the fundamental issue with debt. That's already here. That's been going on for about 111 years now. And so you're not going to change that. So I think the Fed's delusional if they think that they're going to use a few rate cuts to prevent the economy from going into a free fall. And I don't know if we're going to hit the free fall in 2024, but I think we're going to hit very choppy waters as things get worse. So the Bank Term Funding Program really is sort of a nothing burger in that they haven't changed anything, but I think they did the announcement for two reasons. Come get it while you can, and after this, it's not going to be there. And then what we're going to do instead is we're going to use general interest rate policy to ease rates and to soften, what's coming in 2024, which I think they think is a soft landing. And they think that they can engineer a soft landing with a few interest rate cuts. And they don't want to directly bail out the banks. One, it's unpopular, and it probably produces fear. If they were to extend that Bank Term Funding Program, that would be an indicator to the market that there's more problems with the banking system than originally thought, and that may panic people. And so I think what they're trying to do is manage expectations of the economy and manage because what the Fed says actually drives the economy. So I think they're trying to make sure the economy has a nice soft landing, but you can't ignore the debt and you can't ignore the fundamentals. All right. So in other words, I think it's a big nothing burger about the BTFP, but I think the bigger issue is that the Fed's going to use interest rates to engineer a soft landing. I don't think they have a snowball's chance in Hades of actually making that work. So I wanted to address that sort of topic and rumor on the internet about how that may go. The second one has to do with gold oil. So another friend of another, those types of writers that were writing on gold back in the aughts, the beginning of the century, and even before that on message boards, had some very popular postings about what's going on in gold and suppression and movement of gold. But they also wrote a lot on the gold to oil trade. Now, it makes sense if you're going to trade the leading energy commodity for the leading money commodity, it would be oil and gold. And, back before we had paper currencies, a lot of times you're bartering gold for oil. A lot of times countries were bartering things directly, like I'll take your hogs and I'll give you wheat, right? And currencies arose out of the need to have a common unit of exchange, what used to be gold. So the primary energy commodity, the primary money commodity, they trade. And the thought is that if you had enough oil at the right price and you're trading for gold, that gold's price wouldn't rise in dollar terms because you're not trading dollars for it. In other words, you're not bidding up gold through dollars. You're just trading oil for gold. It's a straight trade. It doesn't necessarily affect the COMEX or the London market and the paper dollar value of gold. So let's say you're the Middle East, you're OPEC nation or some other nation with a lot of oil, and you want access to gold for long-term wealth. Let's say you're selling your oil. You bought all the things you need for your country and you have reserves left over. Are you going to put it in dollars? No, you're going to shift to gold, right? You're going to do some long-term storage of gold. So you're going to trade some of that excess oil for gold. And so a lot of what OPEC cuts could be, or increases in production could be, we need to make sure we meet our expenses, without crashing the oil price, and then have enough reserve to go get enough gold to provide us coffers and long-term stability. Because everybody knows gold is the ultimate asset, during economic contraction. So that makes sense. However, there's if you look at the oil to gold price chart, something sticks out. And what sticks out is the fact that when we go into crisis, it doesn't matter how much oil you have, the gold price still spikes. So I don't think ultimately, even if you dump a bunch of oil on the market and trade it for gold, that ultimately it's going to stop gold from having its run, in other words. I do think that if you're trading oil for gold, it does keep the gold price down somewhat if you're doing that physical trade, because it reduces the dollar demand. And less dollars chasing gold means gold price is not going to be as high. And so there's something interesting you can see on the chart. I looked at the gold to oil ratio. This is a chart from Macro Trends, gold on top of oil. So what that means is back here in 1946, in June, gold was trading at 27.56 times that of oil. And this ranged from 10 to 30 times the price of oil, gold to the price of oil, has existed basically for 70, 80 years until we hit something interesting. When we hit the economic shutdowns because of the health scare, what happened was you had two things happen which caused this to spike. Let's go look at the chart. Well, remember in 2020, when the price of oil fell and actually went negative? Why? Because all the economies were shutting down. The instantaneous or short-term demand for oil dropped, but we still had production. So the actual contract price for oil went negative, and that was a sign to stop producing because we got too much and let it re-rise. And it did. Eventually, oil rose back to a really high level of about 118, and then it's come back down. So that's what happened to oil. But at the same time, we're having the health scare and some of these shutdowns. What happens to gold? Gold is a fear asset or a safety asset. So it went from about 1,500 to a new all-time high of about really 2064. So it went up about $560 in the span of about a year during, well, a little bit less than a year during the health scare time, right? So that's why you see this spike. Oil demand fell, causing the oil price to fall, and gold demand went the exact opposite direction for the same reason. Economies are shutting down. People are scared. They buy gold. And so gold price went up. So then you get this 91.12 ratio of gold to oil. Well, that's an anomaly. It doesn't happen that often. I mean, you did see during the inflation some spikes and moves in oil gold price, but for the most part, it traded in this range. But what that shows you is when the worldwide economy goes into some sort of free fall crash or big recession or even a depression, this is what you're going to see. You're going to see gold spike to oil because people are going to demand less oil because you've got the economies which can't, they're not producing as much. Demand goes down, but the demand for gold, a fear asset, is going to go up. So even though, yes, as of right this minute, you could say that because countries are trading oil for gold, it does prevent gold from reaching its, price that it should be right now. Maybe it should be 2,500, 3,000. We don't know because a lot of those contracts, oil for gold, are not public. We don't know how much oil is going for gold. We know if there's a lot of oil, and there's oil is free flowing, you got a lot of excess reserves, it can bring down that price for gold because you're going to trade oil for gold instead of dollars, and that price for gold is not going to spike. So if you have a lot of free flowing oil, the price of gold could tend to be muted a little bit by that because you're doing a direct exchange. You're not bidding up in dollar terms the price of gold. Well, let's talk about that going forward. That may be true to an extent, but you saw what happened during the health scare. During the health scare, demand for oil falls, demand for gold goes up. So we know if we go into a worldwide recession or depression, we're still going to see a spike in gold. It doesn't matter how much oil you have because the price of oil is going to go down. It's a derivative price just like gold. So if you have gold, oil free flowing, and all of a sudden the world doesn't need it and the oil price tanks and gold goes up at the same time, gold's still going to spike. So the oil for gold trade is not going to stop gold from reaching its ultimate zenith, in other words. It can mute the prices as you go during the bull market until you get to the blow off top. But let's look at oil. What's happening to oil? It's harder to get, more expensive, less reserves. Okay. What the bigger impact on gold price is actually up, not down, because oil, in terms of diesel, especially these far-flung locations outside of cities in the middle of nowheresville, everywhere in the world, where you're having these gold mines, they run a bunch on diesel. They also have diesel trucks. They have diesel, they have refineries that run on oil or oil distillates, or a lot of those complex things that make up the complex of oil production. So in short, when oil prices are higher, that does tend to have an effect on the floor of gold because gold never goes below the cost of mine. Like in the last 100 years, gold's not gone below the cost of mine. So if your energy costs are going up, gold's going to go up. So at the same time that that oil gets more scarce and more expensive, it drives up the price of gold. So if you're then trading your excess oil reserves for gold, that's why it's in a range. So the bottom is capped by the fact that oil inputs and that gold to oil ratio, let's go back to the ratio real quick. Let me explain how this works. If we really want to know how this works, when the gold price is much higher than oil, it basically means the gold's valued more than oil. It also means that oil got expensive and drove up the price of gold. So when you see a high here on this chart, it means that the oil price as an input to gold has a bigger factor than the ability to trade oil for gold itself. And that's why oil's never really going to stop gold from spiking, because it's not only can you trade oil for gold and keep the price down, but oil prices affect the production cost of every ounce of gold ever produced. And like I said, for the last 100 years, the gold price has never for any length of time stayed below the cost of mine because there's such consistent demand for gold. It's unlike silver, and most gold comes from primary gold mines. So as oil and energy gets more expensive, it thereby goes to show that gold's going to get more expensive. And you're never going to stop gold from reaching its blow off top with oil, because when it's reaching its blow off top, you're not producing a lot of oil. And so oil price comes down and you can buy less gold with your oil. Does that make sense? So even though this is a really cool story going around the internet, the price of oil cannot be used to control the ultimate price of gold for those two reasons. One, it's an input as a cost factor into gold mining. And two, when gold wants to run, usually oil is cratering, and you would have to pump a lot more barrels of oil at cheaper prices to get the same amount of gold. So gold price, so you're going to have to use dollars and currencies. The gold price is still going to go up. Okay. So now let's put those two factors together. Those are the two factors going around right now. And people are like, well, maybe gold's not going to go anywhere in 2024. You've got the Fed with the Bank Term Funding Program and easing, and they think they're going to engineer a soft landing. So gold's not going to spike. Well, no, they're not. Because if you look at the fundamentals of the market, it's not strong. And the Fed easing a couple of times, a quarter point at a time, or even a half a point, it's not going to stop, a recessionary collapse of an economy brought about by debt-based, issues. Now, in 2024, could they use that to manage the first stages of the economic problems in the debt-based system? Yes. But there comes a point at which the interest rates are not going to be enough. I mean, think about it. If inflation spikes really high and we get 18% inflation, the Fed's actually going to have to go the other direction and raise rates. And I think we have inflation coming not only because the monetary supply, but because the supply chain problems that we're having because of war and other things. I actually think the price of things are going to go up more this year. And we've looked at charts about how that happened the last time, from the late 60s to the early 80s, is you had three waves. And I think we're in wave 2, and we're going to start seeing more inflation in 2024. So when it goes to how many rate hikes the Fed's going to make, I don't think they can make a ton this year. And that's the poll I put out. How many rate hikes do you think? Well, if we start having higher inflation and deflationary issues in the economy, the Fed's going to be stuck. They're going to want to cut interest rates and raise them at the same time. They're screwed. And that's what happens at the end of a fiat cycle, a debt-based fiat cycle. And that's why I don't think the Fed can control anything. So whether or not they're doing bank term funding programs, all it does is kick the can down the road. It makes the problem worse. The Fed ultimately, either through those programs or interest rates, cannot stop the economy from collapsing, because the debt-based economy was caused by Fed policy. So they're not then the cure. They don't have the power. Once you have that collapse in the debt-based fiat systems, history shows it doesn't matter what the currency is, that the value of that currency is going to its intrinsic value of zero. It doesn't matter what the central bank does. We've seen that story enough times. I'm not buying that the Fed could stop a collapse. Can they manage the first parts of a collapse to make it seem softer? Yeah, but that's actually more dangerous, because it gives false hope to people that maybe we're not going to recession this time. And that's why if you read in the mainstream media, like, oh, we avoided the recession. We don't even have to have a soft landing because of the Fed management, the bank term funding, and other things. But those are kicking the can down the road. Those are Band-Aids. They're not curing the disease. It's a Band-Aid over the top. It's an antibiotic over the top. They're not curing the disease. And the oil for gold trade's not going to stop gold from spiking. We saw that when you had a preview of what's coming in 2020 with the shutdowns, with the health scare. You had oil prices tanking. So oil at that point is no limiter on the price of gold, because it's so cheap. You'd have to throw so much out there. And all the while leading up to that, the oil prices were rising, causing gold to rise. So I'm not buying the fact that the oil for gold trade is a cap on gold. I do see the ratio. I showed you the ratio, but that's never really stopped gold from popping if you're getting into one of these big worldwide issues. Now, to be fair, if you look at 2008 and you look at 2000, those were primarily American market issues that were addressable by Fed policy and incredible amount of money printing, which is eventually going to lead to the big crash. During the big crash, it ain't going to matter. So don't let 2000 and 2008 color your view on whether the Fed can stop a debt-based economic collapse of the currency. They can't. In fact, the Fed will be washed out when that happens, because now with bank term funding and all these other problems, you're taking on more of that risk. And at the end of the currency cycle, the Fed's going to be monetizing debt directly, because nobody's going to want US debt and they're going to be buying it all. So the Fed will eventually itself come under collapse. And that's where gold spikes. So if you're buying gold for short-term trading, you probably care more about the gold to oil trade, and you care more about the derivative contrast price and COMEX and London, all that stuff. But if you're buying gold for a long-term asset to guard against long-term effects of inflation and a long-term economic collapse scenario, or a fiat currency collapse scenario, which is very predictable, then you're still safe in gold. And what you have right now is an opportunity to get it cheaper. and I've said that 1,000 times, if you're worried about the price of gold today, you're not looking at the big picture. What you have the ability to do now is get gold cheap relative to where it's going to be at the end of the system. And it may take a couple of years ultimately for the system to finally get into that collapse stage. I don't think it's going to take long. All you got to do is look at the bank failures. Not only was it the 3 in the US, it was Credit Suisse. And we're looking at the banks now, Bank of America, Wells Fargo. The banking system is very fragile. So we know it's coming, and history says it's coming. So I don't think anything the Fed does is going to stop it. And I don't think when gold wants to run, the oil is going to have any chance of doing anything. It's not going to have any effect whatsoever on that gold price. Does it have an effect now? Yes, it does keep it within trading range. That trading range, the oil to gold trade and that ratio allows you to get gold cheaper. So my suggestion, and I'm not a financial advisor, do your own research. But what I am doing is I would say, okay, regardless of what happens to oil, I'm going to buy more gold. And it's good that oil can be used to manage that ratio for right now. And it's also good, I guess, that the Fed did those things, kick the can down the road, because the system's going to collapse anyway. It just gives you more time. But I still think time is running short. But I wanted to address those issues because a lot of stuff, there's a lot, even within the gold community, there seems to be a lot of indecision and confusion about where gold's ultimately going to end up. None of these things being talked about ultimately are going to change the path of gold. When the fiat system collapses and the central bank system collapses and they come out, and move us into the new currencies, you're going to have that window of about 6 months where gold is going to spike. And that's where you're going to trade your gold for things that you need. And that's never changed. It's not going to change. But I felt like because these are running around the internet and they're very interesting stories and it's good research, that people are getting false hope that, one, we're not going to have the deflationary collapse of the debt-based fiat system, which we will, but two, that the Fed can engineer a soft landing, which they can't, and three, that the gold for oil trade is somehow going to prevent gold from reaching its blow-off top. It's not. So in other words, they're all nice stories, and in the meantime, until we get to that final collapse scenario, yeah, it does affect things. But again, that just gives you an opportunity to buy more if that's what you want to do. That's what I'm doing. But it's not going to stop the ultimate result. And that's what I wanted to address. And I wanted to address it in a way that makes sense for you guys. That was common sense, logical. Let's think about this. Let's look at, scenarios. So as you're kind of reading online and you see these topics come up, just remember the long-term picture. It does not change for gold. And all of these mechanisms that are keeping gold within certain trading ranges, both positive and negative, are just opportunities to get into the physical until real price discovery returns in the economy, the fiat currencies collapse, and gold becomes the ultimate pricing mechanism for everything, including oil. Because I guarantee you right now, when we get to economic collapse scenario, people aren't going to be saying you're pricing gold and oil. They're going to say you're pricing everything, including oil, in gold. And that's the way it works. So don't get fooled by these stories. They're great stories. They do explain some things as we go along. But ultimately, gold is always, has been, and will be this time, the ultimate determination of value of everything else. And it will return to that. And if you, like me, have gotten into gold now, what you've done is created an immense amount of potential purchasing power for yourself in the future, I believe. And again, do your own research on that, but that's what I believe. And if you believe that, then now you know, as Paul Harvey says, the rest of the story. All right, that's going to do it for today's video. I think there's a lot of good information in there. It doesn't change the big picture. I don't think it changed the picture for 2024, although as we get in 2024, I do think that Fed policy is going to help reduce some of the turbulence, but they ain't going to stop it. And I still think 2024 is going to be very choppy. And I do think it helps us to keep our eye on the prize, understand why we're here in the precious metals, understand the facts, the long-term facts, the long-term case, and how that hasn't changed. And I thought it was some good research just to talk about. It's interesting thought exercise to see how all these things relate to each other. And it helps teach us about the market. And it does matter. But at the end of the day, it doesn't change the end story for gold at all. It's not going to change the end for gold or silver. They're still going to do what they're going to do. And I think ultimately even silver will be priced in gold ultimately, because silver is more of a commodity now. Now, silver may rise more than a percentage of gold, but it will be priced in gold terms, not in fiat currency terms. And that's where the gold silver ratio is going to be even more important going forward. And that's a hint for you. Look at that gold silver ratio if you're buying gold and silver, and determine for yourself how you want to use that ratio to allocate your spend on gold and silver. Gold, more than silver, will be the ultimate financial asset in the system. That I am sure of. And it does not change based upon what the Fed does or what the OPEC nations do. It does not change at the end of that cycle. The end of the cycle, the truth always comes. It's coming. So don't get distracted by this. They're good thought exercises. It does explain some things. It does not change the end result for gold based on what we see coming in the economy. All right, until next time, this is Rob Kientz with GoldSilverPros.com.